So, so you basically help administer 401k plans for companies. Now, you see some of the mistakes people make. Now, what are some of those mistakes? Like, for instance, maybe people not taking full advantage of the company match. What do you see?
Yeah,
You know, and
that's very common.
yes.
That's very common.
What are the common mistakes?
Well, we try to illustrate that a company match is basically free money. If you're not getting the maximum match, in other words, if a company says they're going to match 50% of the first 6% that you defer, that's free money. If you're only deferring 4%, then you're not getting all of the company match that's available, which is like, if someone offered you that money in cash, you wouldn't say no to it. But it really comes down to the deferral rate. And we think people defer far too little. They don't take advantage of the online tools, which can predict where they're going to end up by looking at how much they're deferring. And most people defer far too little. So we try to get the message to them while they're young that you really should try to get to 20% as quickly as you can.
So you're saying basically, and have deduct 20% of your income to go into your retirement.
Regardless of what the corporate match is. Because the corporate match is maybe if you get 50% of the first 6%, you think 6% is enough. It's not. If you run the numbers, deferring 6% even for 30 years isn't going to give you need about 10% over 30, 35 years to make $1 million contribution or $1 million result in your 401k plan. And that sounds like a lot of money, but in 35 years, $1 million won't go as far as it goes today. So you really need to think 20%, which if you make around 7% in your diversified portfolio, you don't borrow money out of the plan, and you don't move your money in a down market out of what went down into a money market fund thinking it's safe. If you don't make those classic mistakes, then 20% deferral for 35 years might get you to the $2 million level, which seems fantastic, but you can stage yourself into it. You don't have to do 20% right away, but have a plan of increasing your contribution, say 1% a year.
Okay, so you talk quickly about two of those mistakes. So let's talk a little more detail about
Sure.
it. Okay, so the first one is people borrowing, either making withdrawals or borrowing against their retirement plan. So okay, that's your first mistake. What's wrong with that?
Well, let's look at this historically. If you borrow money out of your 401k plan to use for something else, you're taking it out of the market. Statistics show that if you miss, say, the 10 best days to be in the market because you've borrowed the money out, it dramatically reduces your overall return, dramatically. And you can go back and study this, but you don't have to dwell on it. The people who are most successful don't borrow from their plans. And that's just something that you find the money someplace else. And if you can't, get it back as quickly as you possibly can.
Okay, the next one was pulling out in the down market. So people look at their statements like the market is going down, and they freak out and they move their money to more conservative investments.
Right.
Okay, and you see that a lot.
It's a classic mistake.
Okay.
What we have to teach people is that volatility is your friend. If you are making regular contributions every month, the volatility helps you in a special way called dollar cost averaging. When the price of your number one stock goes down and you send the same amount of money, you're buying more shares. And as you get more shares, you are accumulating a position which in the future, those shares are going to be replacing the income that you're earning. So if you buy them for low prices, there's nothing wrong with that. And people have a bias. They think that investments, it's the only thing people don't buy when they're on sale. They try to switch out. And the other issue is you don't know when to come back into the market. And so you might be out far longer than you should be. It's best to just leave it alone.
You're basically locking in your losses.
Well, you don't have, this is another thing we tell people. When you have a down market, you have what's called a temporary fluctuation in value. Temporary. That's the key word. If you move your assets out of your equities that went down, you have a loss. Your accountant says if you sell something for less than what you paid, it's a loss. If you don't sell it, it's a temporary fluctuation in value. Knowing the difference between the two makes all the difference in the results of your plan.